So, hey guys, what's up? We're recording this in tandem with our stream right now. What we're pointing out right now is something kind of important. We're looking uh, at the U.S. Treasury bond rates right now, and so, we've kind of been avoiding that for a long time now. I mean, like, just the whole market in general hasn't really been paying too much attention to it, but today, the TLT, the VIX, all these, and gold actually, all of these gapped up. And yesterday, the market received about a 1% move, a 1% drop very suddenly. And we didn't really know exactly where that came from. So, and now with the upswing of the TLTs, gold, we're starting to have to look back at the deep fundamentals of what's going on in the market, and one of those right now is the bond rates. So, do you want to go ahead and explain this part? Basically, yeah,
You got it. Okay. Yeah. So for any bond rates, you typically want a higher yield return for long-term holds. As an investment, as something guaranteed, you would want that in something. But in this case, you can see that the yield rates here are much lower than the short-term 3 months hold, and so that doesn't make sense for just traditional investors to actually do. They're getting a higher yield for a shorter term, um, a shorter time period, and
and that's
so
that's that's bad because that incentivizes people to purchase things in the short term, which
right.
is not how the economy works. Markets want longer term positions. They want long term growth, right? And so because here you're seeing that out of 3 months you get 1.5% out of buying one U.S. Treasury versus buying the 2 year, which gives you less. People are automatically going to pick the 3 months, and the reason that is because if if you have a choice between putting in $1,000 and getting 1.5% out of it or 1.3% out of it, you're going to take the one that's higher. Plus, this one requires you to spend in less time. And as a result of that, that means you're in a short-term economy. We were talking about this way back when, at the beginning in August, when this was still happening. This is back when when the 10-year and the 2-year inverted. That's what's when. So what that means is when the 2-year is higher than the 10-year, that's what we considered, at least at the time, to be considered an inversion. You can use a few of the other ones too, and it would still be the same thing. For example, right now the 10-year and the 3 months are inverted, and because of that could potentially be a yield curve inversion, because these are the yields of the U.S. Treasuries. Now, one of the things that's very problematic is because the 3 months is so much bigger than the rest of these and not the 30-year, and we kind of expect that the 30-year will remain kind of where it is, because they're still long terms. Um, Actually, no, that's not entirely true because during August they had dropped to the lowest it had ever been.
Mm.
So it had come down quite a bit, and so today, I mean, it's higher than that, but I mean, this is a bad outlook as far as like people's expectations of the future. This has a tendency to be like lots of uncertainty, lots of a lot of these different variables that kind of put people off. So this is a very important thing, along with the information about oil. Uh, is oil no oil is down, but or oil is up, but not as much as the TLT, uh, gold, right?
I don't know. Yeah,
Okay,
sure,
well,
but
I'll go ahead and research that a little bit further. But for right now, this is a very important indicator for how our outlook in the rest of 2020 might be. So keep treasuries on your watch, keep the bond rates, keep all of that in mind. Watch the TLT, which is the 20-year treasury rates on Barclays. What is it? It's Barclays. Barclays has an ETF that defines it. So that's what that is. So keep an eye on that, and then watch for gold, the prices of gold, and the VIX, which is the volatility indicators. When those start spiking up, that's when you start to see the S&P 500 start to spike down. So just keep that in mind as you kind of go along with this market. I'm not saying there's a recession, but I'm saying that these are pre-indicators to a recession typically. So that's what you want to keep in mind.